Hello, I'm Jared Nelson from the Investing Channel, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. Oil prices are on the rise again. At the end of last week, West Texas crude, heating oil, gasoline, Brent crude, and ethanol all marched to their 52-week highs. Their one-year returns are all in the region of 90%. No wonder everyone is concerned about inflation. Against such a strong uptrend, expectations are climbing. Bank of America, for example, is expecting a spike in crude prices to $100 a barrel in the not-too-distant future. The last time investors saw such a massive jump in oil prices and sentiment was back in 2007. At that time, not only were energy prices leaping higher, but food prices were shooting up too. A twin rally that is also happening right now. The current situation reminds investors of the market turbulence just before the global financial crisis, a weakening economy wrecked by sharply higher commodity prices. As oil prices climb, traders are claiming that oil consumption is rising faster than supply, creating a market deficit for oil. However, how long can this so-called crude deficit last? Is buying energy securities amidst this deficit oil market a certainty? A month ago, the Paris-based International Energy Agency revised down the growth in global oil consumption to 5.4 million barrels per day. One big concern is the current pandemic in India, which is hitting the economy there and dampening global oil demand. Meanwhile, the oil organization OPEC Plus is gradually increasing supply into the market after massive cuts last year. Just a few days ago, OPEC affirmed that it will press ahead with an increase of 840,000 barrels a day in July. If oil prices continue to rise, discipline amongst its oil-producing members may break down and lead to more supply into the market. The last point concerns traveling. Summer holidays abroad are pretty much dead in the water after the emergence of the newer and more powerful Indian variant. Foreign travels can seemingly be stopped and deterred at the last minute. Even the UK, which has fully vaccinated 40% of its adult population, is having doubts about a complete reopening in late June. Therefore, it is not necessary that oil demand will follow the anticipated trajectory of the market. So no, buying energy now is not a one-way bet. It reminds us of Bitcoin back in March, when crypto prices and the underlying trading sentiment were red hot. But all this bullishness completely reversed within a few months. Yes, based on its recent price momentum, crude prices may extend higher. Short-term buys with a time-limited holding period may still work out, but the risk-reward for long or intermediate buys now are poor. In today's volatile market, it pays to buy on setbacks rather than chasing extended trends higher. Curiously, have a look at U.S. Treasuries. The inflation thesis is not being confirmed in that sector. For example, the iShares Long Maturity Treasury Bond ETF is stabilizing above its March lows despite recent higher-than-expected inflation data. If you analyze TLT's chart based on technicals alone, that is, using a price-driven trading approach, you will come to the conclusion TLT is developing a near-term base formation. A break above 140 would be bullish for the bond ETF and bearish for interest rates. And according to Trackstar IQ, our proprietary search tracking tool, institutional investors have been paying close attention to this ETF in recent weeks. So, what about energy stocks? Surely, if crude prices were to stay bullish, oil majors would benefit greatly. They do. First quarter results from ExxonMobil, XOM, and Chevron, CVX, show them making $2.7 and $1.4 billion net profits respectively. As long as crude stays firm, 2021 could be a great year for oil majors. The question, is all this bullishness priced in already? Remember, markets are forward-looking. Exxon has already doubled from $30 to $60 on the back of a sustained rally in crude oil. This rally is as strong as the one back in 2003 to 2005, when the commodity supercycle was about to roar into life. If anyone is buying Exxon now, they will be looking at the near-term upside at $70, a gain of about 10 to 15% from the current price level. The downside risk is of similar magnitude. All in all, the energy complex is basking in bullishness these days due to an increase in consumption post-lockdown. No longer is the world awash in petrol. For investors, however, it is not a straightforward decision to overweight energy because of the underlying risk. The low-hanging fruits have been picked. At this point, we are chasing short-term momentum rather than buying value. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.